We're getting an interesting reaction on shares of Birchcliff Energy, initially surging this morning after the company followed through on plans to boost its dividend by 900%. Now, Birchcliff, of course, is passing on rewards to shareholders after a banner year for natural gas in 2022. At the same time, they're also increasing their capital spending expectations for the period going forward, citing a combination of higher inflation and perhaps lower prices for natural gas. Now that natural gas prices are back to where they were starting in 2021, analysts are eager to know, at what price does the newly founded dividend become unsustainable? Let's bring in the CEO of Birchcliff Energy, Jeffrey Tonken, who's joining us. Jeff, thanks so much for being with us. That seems to be the number one question by the street. A 900% boost to the dividend certainly will be welcomed by shareholders. There's questions around sustainability as nat gas prices come off. What do you say to that?
Well, first of all, I say nice to see you, Amber. I haven't seen you for a while, so that's most important to me.
And Happy New Year.
Yeah, the same to you. And I think, I'd say three things. Since I've last saw you in person, we've paid $920 million of debt retirement. So Birchcliff is a far different company than it was when you saw us 3 years ago. So essentially, we've cleaned off our debt. Second thing is, yes, we announced percentages are wonderful, but when you look at the hard numbers, what we've done is we've said at strip prices today, we'll generate about $570 million of cash flow this year. We'll spend $270 million to generate about 82,000 barrels a day of average production. That leaves us with $300 million of free cash flow. And of that $300 million, we are going to give our shareholders $213 million, which is 80 cents a share or 20 cents a quarter. So that leaves us with $87 million of excess funds. If oil averages $70 this year, and natural gas averaged $3, that $87 million would disappear, meaning that's our breakover where we could not fund all of our dividend and our capital expenditures out of just straight cash flow. So we're good to $70 oil and average $3 gas. So we're pretty comfortable that those averages, if we get down to that, we still can fund our dividend and not have to draw down debt. And
I was just going to say, nat gas prices, oil prices are far from $70 right now, but nat gas prices are close to that level. And it's led many to ask the question, you're 100% unhedged. Are you looking to perhaps hedge some of that exposure in a downside situation?
Yeah. So, Amber, this is beautiful. The road to hedging is the road to hell is paved with hedging. And so, although it's kind of funny, 2 years ago when natural gas prices were exactly where we are today, everybody said, oh, hedge. And then they said, hedge at $4, hedge at $5, hedge at $6, hedge at $7, hedge at $8, hedge at $9, and then all the way down. And so a lot of companies left a lot of money on the table. What I would say is because we are unhedged, we paid all our debt off, more or less. We got every dollar when things were good. But at the same time, you have to remember Birchcliff is a very low-cost producer. And my expectation is that if commodity prices stay where they are today, people are going to quit drilling, and it's a cycle. And guess what's going to happen? Now you'll see it go the other way. The second comment I would make, though, is we've had a very warm January. Now, by the way, it's only the 19th of January. Winter is not over. And last year, the warmest part of the year was actually, it didn't start to get cold till the 25th of January, and then it was brutally cold for a few months. So we'll see where this all lands out. But do I think $3 gas is going to, that's the tip over point? If we have to draw a little bit of debt down to keep the dividend, we'll do that. But I guarantee you next year, if commodity prices are weak, we'll cut our capital. And I know that our costs will come because industry will come down because industry will be slower, and we'll match our CapEx program plus the $213 million to match our cash flow. So CapEx and dividend will equal cash flow. So we're pretty comfortable with where we are in light of how strong the company is and where we set up on the overall cost structure. And no, we will not hedge because it's a cycle. It always is. And when it's good, we'll be increasing our base dividend to our shareholders.
And that's was going to be my follow-up question. You know, if there is softness in the market, what levers do you have to pull? And it sounds like the lever you're going to pull is on capital spending. And I wanted to unpack your views. You know, boosting your dividend in this market could be viewed as a bullish signal for natural gas. And some are concerned that we are seeing increased production at a time when we're wondering where that demand growth is going to come from. What do you say to that fear? Because it sounds like you have a different take on how industry would respond to weaker nat gas prices.
Yeah, so you asked about the high and the low sides. I expect if natural gas prices stay low, over in the next period of time, you're going to see industry slow down their spending because everybody ran budgets on much higher numbers. And you could see much higher assumptions. And you can see from our assumptions, we just ran it at strip. Strip's actually stronger today than when we ran it 10 days ago. So strip just moves around every day, right? It's hard to bet. But from the upside, my view is demand, where is it going to come from? Well, Freeport will be back on here fairly quickly in the U.S. That's 2 BCF of gas. There's a number of other LNG projects coming on. That's creating new demand. The country of Mexico is taking more gas out of the U.S. So I don't think that people realize that at a minimum we'll have about 13 BCF leaving the U.S. out of LNG and over 7 BCF and growing to Mexico. That's 20% of the production produced in North America is going to go out the back door. So my expectations, if you believe that everyone's going to go from coal to gas and the LNG projects are going to continue to be built out, that we think the demand for natural gas is going to be strong. But either way, what's most important to me is our numbers work at very low commodity prices. And I emphasize to you that because we own all our infrastructure 100%, and we have no third-party processing obligations, I can walk down the hall and say to our drillers, we want to drill less wells next year, and down comes our capital. So we're not chasing production, we're chasing cash flow and margin, and enough of cash flow to fund CapEx and that dividend and not draw down debt so we don't run into a balance sheet issue ever, period.